What stops many people from investing in the stock market is they think they need to spend every single second, every single day looking at stocks. How many cans of Coca-Cola did they sell this quarter? How many shoes did Crocs sell, and so on? And I'm here to tell you that you can invest with a couple minutes every single month, and that's with my dear friend, index funds. I talk about index funds on every single platform that I'm on, and this is all that I invest in myself. An index fund is a mutual fund or an ETF that packages a bunch of stocks and sells you them all at once. You can think of this as a Halloween basket. If I go to the store and I buy Halloween candy, I'm not just gonna buy one bag of Three Musketeers. Number one, who likes Three Musketeers? And number two, I want different types of candy that I'm gonna be passing out. So what do? I get the mixed bag, the bag that has Snickers, Twix, Laffy Taffies, M&M's, Three Musketeers sadly. That way I have a diverse section of candy that I can pass out. And if someone doesn't like Three Musketeers, I still have other things that I can pass out to them. It's the same idea with stocks. Rather than buying one stock like Apple and having all my money in Apple, what an ETF or a mutual fund do is they package a bunch of stocks like Apple, Nvidia, Microsoft, so many other more depending on the index fund or the ETF that you're buying, and sells you those all at an affordable price. And specifically with an index fund, they track a specific index like the S&P 500, the NASDAQ, Dow Jones, the Russell 2000, and so on. So like I just said, an index fund is a type of ETF and mutual fund. But what's the difference between the two? Well, ETF stands for Exchange Traded Fund, and these differ from mutual funds in a few ways. Number one, they can trade like stocks, while mutual funds only trade once a day, which is usually at the end of the day. ETFs have lower expense ratios than mutual funds. ETFs also require no minimum investment like you do with mutual funds. Mutual funds, you need to invest at least $1,000 on some mutual funds, $2,000, but with ETFs, you can invest as little as $1. ETFs are also newer, so they're more tax advantaged in most situations. Also, for the most part with ETFs, they're going to distribute the dividends towards you, and in mutual funds, most of the time, they're just going to reinvest them for you into that same package. One disadvantage with ETFs is that sometimes you may not be able to automatically invest to ETFs, depending on the broker. With mutual funds, no matter the broker, you can automatically invest to them. So why so much talk about index funds? Why is this the only thing I invest in? Well, there's so many advantages with index funds, and the first one is the diversification. I touched up on it a bit earlier, but something like the S&P 500 diversifies itself into 500 companies, specifically the top 500 American companies by market cap. Market cap just means how much that company is worth. But diversification is simply the reason why I invest in index funds. Say I invest myself and I have a 5-stock portfolio. In each of those stocks I put 20%. If one of those stocks go down, I just lost 20% of my portfolio. On the other hand, with something that has 500 stocks like the S&P 500, 1, 2, even 3 companies go down, you don't need to worry about it because there's so many other companies that's going to balance itself out. And with an index fund, you don't really need to pay attention to all 500 companies. You don't need to look into earning reports every single day on 500 companies. That would be impossible. But if you have 5, 6, 10 companies in your portfolio, this is a small portfolio where every company matters. So you really have to pay attention to what these companies are doing. Another thing with index fund that makes them so good to invest in is that they're so easy to start with. You're not pressured to one company. You don't need to dive into every single detail of that one company and put your money on that company. You invest in a group of companies or 500 companies like the S&P 500, and then it kind of eases you into investing. And then down the line, if you actually want to get into some companies and you read the reports, that's also a good way to get into it. But with index funds, you can start with as little as $1. You don't need thousands of dollars to get going in index funds. Also, with the index funds, since they're tracking something like the S&P 500 or the total stock market, they're pretty safe investments in the long run. Of course, with index funds, you have the opportunity for falling stocks or even going down like you've seen in 2008 or 2020 or 2000 dot-com bubble. But over its history, we've seen the total stock market in the S&P 500 perform at an 8 to 11% return on your investment. Like I said, this is over the long term. If after this video you go buy an index fund and the next day it drops, this is very short term. You should not be paying attention to that. Because when you're investing for index funds, it's for the long term, for retirement, for 10, 20, 30 years. This is not a get rich quick scheme. Another thing that makes them safe is if you look at any 20-year period with the S&P 500, there has not been a decline in its performance. So what I'm trying to say is if you invested 20 years ago, the S&P 500 is higher today. If you invested 20 years before the Great Recession, it was still higher on the Great Recession. If you invested 20 years before the dot-com bubble, it was still higher on the lowest point in 2000 than it was 20 years before, which goes to show how powerful it is in long-term investing. Another reason why I invest in the S&P 500 and other indexes is that you really can't beat this returns over the long term. In fact, Warren Buffett was so confident of this in 2008 that he made a $1 million bet to anyone in the world, any professional hedge fund trader, that they cannot beat the S&P 500 over the next 10 years. Someone actually did pick up this bet, and to no surprise, 10 years later, when this bet was over, they were not able to beat the S&P 500. So why try to put all that time, all that effort to not even beat the S&P 500? Investing in an index fund is so much easier. Spend no time on earning reports, and you're probably going to get the best returns out there over the long term. Don't come after me if your stock is up 1% tomorrow and the S&P 500 is only up 0.2%. Now jumping over to passive and active funds, what's the difference? Well, active funds is where there's someone behind the computer that's actually moving stocks around. One example of this is Kathy Wood's ARK funds. She has people, or even herself, go in there, they pick which stocks go in there, they pick how much stocks are going to go in there, they trade every single day, they want to sell off some Tesla, they want to buy some Tesla, they want to sell off some Apple, whatever it may be, they're controlling the stocks that go in and the stocks that go out. And with these active funds, since there's someone that's working so hard towards these funds, they're going to have a higher expense ratio. The average expense ratio with an actively managed fund is 0.5% to 1%. That may not seem like much, but that's $1 on every single $100 you make. And over the long term, when compound interest takes an effect, that could be a good amount of money. On the other hand, index funds are a passive fund. Index funds solely follow the index, like the S&P 500 or the NASDAQ or the Dow Jones. And then each of these individual indexes have their own criteria. And then since there's no one behind the counter running every single transaction every single day, they don't need to have the high expense ratios in passively managed funds. Something like VU has a 0.03% expense ratio. This is $3 on every $10,000 you make. So aside from passively managed funds having a lower expense ratio, you don't need to keep up with the changes. Index funds like VU are rebalanced every single quarter, but that's just to keep the amount that they have of each stock in accordance to its market cap, because the S&P 500 is based on market cap. For bigger companies, they have more stock. But with active funds, they're going to be moving stocks every single day, every single week, and you're really going to have to see what's going in and out to make sure that you still align with what that fund's going for. Now, which index funds are good? I talked about what they are, but which ones do I invest in personally? Like I said, this isn't financial advice, so make sure you do your due diligence and that you're actually researching what you're investing in. Personally, I invest in a few. The first one is VTI, which is the total American stock market. This includes every single public company on the American stock market. The performance of VTI is really closely aligned with VU, which is my next index fund, which tracks the S&P 500. Both of these you can expect 8 to 11% over the long term, 10, 20, 30 years. So the V in VTI and VU stand for Vanguard, but you don't need to have a Vanguard account to buy these stocks. Many people think that you can only buy Vanguard funds on Vanguard brokerage, but you can buy these on Robinhood, Webull, Fidelity, Charles Schwab, whatever brokerage you use. Another index fund that I invest in is QQQM or QQQ, and this follows the NASDAQ. The NASDAQ follows more tech-heavy companies. These don't include banking or financial sectors. They're not going to include Bank of America, Chase, or whatever other banks are in the top 500. And usually in bear markets, these are going to fall harder, but in bull markets, these are going to rise faster. But if you're looking for something that's dividend-focused, another ETF, it's not an index fund, is SCHD. This is a dividend-focused ETF. They package a bunch of companies like Home Depot, Pepsi, Coca-Cola, with any other companies that they think are good dividends, and sell that to you. So these are ones that I invest in myself, but in order for you to know what you should invest in, you should really align your goals with your timeline, what your risk tolerance is, and any other factors that you need to invest. So personally, I invest only in index funds for the majority. I do have 10% in other stocks that I believe in, but I think the majority of everyone's portfolio should be index funds. Again, opinion. And with index funds, you want to have that long-term mindset. If you buy VU or VTI and it goes down in 1 year or even 2 years, you should always have that mindset that these stocks are on sale. I'm going to buy more, I'm going to lower my cost because I'm really buying these for 10, 20, 30 years. I don't plan on selling any of my index funds for at least 20 years. So why would I care if it's down in 5 months? With these index funds, since they track 500 companies or even VTI, which tracks every single American company, they're going to see their ups and downs because the economy in America is cyclical and VTI and VU will follow. So make sure you keep the mindset that these ups and downs are normal and that this is just a good way to buy more for less. So I hope that really taught you guys something about index funds, how to invest in index funds, which index funds are good, what makes a bad index fund, and so much more. Make sure to drop a comment on what your thoughts are, like, share with a friend, and of course subscribe, and we'll see you guys in the next one.